Happy Thursday. Welcome back to another episode of Go FUD Yourself. Oh boy. There we go. Had to switch us around. Can't function if it's anything is out of place. And I was out of place. Anyways, new episode of Go FUD Yourself. We're a live show Monday to Friday, 12:30 p.m. Eastern. We're on all the major venues. Like, share, subscribe, help us get the word out. Today, Kiara is not here, obviously. And we're joined by my good friend, Patrick. How you doing, brother?
I'm doing fantastic.
Awesome. We're down here in the depths of winter in Miami. Patrick's also a Miamiite. Miamian? Miamiite? I don't even know what they call us. And we're all freezing right now. It's probably in the mid 70s still, and everybody's like just complaining and freaking out. So good times down here in Miami. Anyways, Patrick does some really cool stuff. Why don't you tell us quickly what Arrow Markets is all about and what you're cooking up?
Yeah, Arrow Markets is an options trading platform on Avalanche. We have a major launch coming in to the new year. So everyone should follow us on Twitter at Arrow Markets to stay on top of all of those developments, because we do have a lot of really exciting new stuff coming out in the new year.
Amazing. Yeah, we'll put all those links. Producers will put all the links to Arrow Markets and your socials and stuff. Yeah. I'm
also wearing, shameless self-promotion. I'm wearing the Arrow Markets original sweatshirt from maybe 2 years ago, and I'm sure I'll get some crap from you and maybe Lucas about not distributing enough of these.
So this is a running joke in our friendship for the last few years, is that I think I'm the only person on earth that has wanted but not received an Arrow sweater. So he wears it just to mess with me. But a quick shout out to our other merch sponsor today, Chainlink, good friends of ours, obviously pioneers in the space. We've done a lot of work with them, but it's a long sleeve shirt, which is not that common in crypto merch, and I flippin' love it. Chainlink is always good for good quality material and all that stuff. So quick shout out to Chainlink. Okay, what are we talking about today? We are talking all things stablecoins. And there's kind of a theme for the day, of course, not necessarily because it's dominating the news at the moment, but rather, something that we've kind of been talking about for months, but is now starting to come into the public view a little bit because of regulation and more eyes on the space again, because we've had a little fun in the last bit. So Patrick has written some Substacks. We're going to talk about that later. One in particular on this topic. So I'm really excited to dig in. So without any more waiting, let's freaking go. All right, we're back. Patrick got his dance out during the intro theme song, so now we're good to go. All right, brother, we're gonna start with pretty high level view of the stablecoin business or the stablecoin industry. Essentially, setting this one up, there was a report from the S&P that essentially scrutinized stablecoins. It was a bit of a hit piece, I think. But there was probably some truth underlying some of their claims and things that maybe us as a space and regulators should possibly look at. What are your thoughts on this? Like, do you think that the stablecoin design as we see it right now, Patrick, is additive in terms of value accrual, or is it just more of the same?
So my sense is the stablecoin technology the benefits have yet to be fully realized, and we're kind of leaving a lot of value on the table in terms of what could be done with stablecoins versus what is typically done with stablecoins. And in this report, they point out a few things that I kind of agree with. Some of these stablecoins promising yield, I think they noted as a potential regulatory risk. And my sense is that's kind of not where stablecoins shine in terms of their ability to add value to markets. My sense is that asset-backed stablecoins function very much like consumer banks, but they do so with after eliminating almost all of the overhead of operating a consumer bank. So that's where I think there's an enormous amount of value being left on the table. We can talk a little more about the mechanics of that, but my sense is, look, they point out some things here that I think are valid in terms of notes of caution, things to be aware of if you're looking at kind of the stablecoin ecosystem. That being said, I think there's a huge amount of kind of untapped, unlocked value that stablecoins could add. A lot of value just kind of left on the table currently.
So a couple of notable quotes, I think, from the article that are worth suggesting. So some of the things that they were cautioning against, the first one is the promise or mention or implication of yield. A lot of these stablecoins, when you custody your fiat, you're getting yield, and that, according to the S&P, and I think according to most people in the space, would suspect that makes stablecoins securities. And currently, we don't have stablecoin legislation in the United States. And if you have any users in the United States, which every stablecoin pretty much does, that becomes slightly problematic if you're deemed a security and are unregistered. So that's a problem. Totally get it. Another notable quotable. I don't even remember where that came from. Notable quotables. Do you remember that? It's from like some. Anyways,
I'll credit you.
Yeah, I'll take full credit for coming up with that. Another one is, they're obviously, they were bullish on the idea that it's, really fast transactions, significantly reduced borrowing costs. It's a lot more efficient movement of US dollars. But some of the other kind of criticisms they had, I think, were around the foreign nature of some assets, in particular with Tether. And we'll talk about that in a second. That's part of my challenge with stablecoins in general, is just the way that the collateral has been managed up until now. In any other environment, that would never be acceptable. There was a time where Tether owned commercial paper in China. Like, that was part of what they were holding as collateral. I mean, commercial paper in China is not
very risky.
Yeah, there's a lot of risk involved. And there was some suggestions that they even held real estate at one time, which is kind of interesting. I think a lot of that has been, we've kind of rounded that bend. I think there's been a lot of proof of reserves that have, that has come onto the space now. Obviously, Chainlink, we actually piloted with Chainlink that proof of reserves on Benki. We were the first protocol to use it, which was really exciting. I think it's great to bring more transparency and more trust into an otherwise somewhat opaque environment where these stablecoin issuers are quasi-centralized. Anyways, as far as additional risks, Patrick, they talked a little bit about bank runs and so on with respect to stablecoins. I mean, we saw some stuff like that kind of happen with Terra Luna and UST. We saw a little bit of it with BUSD for a minute when that was kind of shaky, but it has since recovered. What are your thoughts on that? The greater the use of stablecoins, should we be increasingly worried about bank runs with the amount of assets that are sitting in these stablecoins?
I mean, so it depends a lot on what the criteria are for the assets that back the stablecoin. So you mentioned, a few points here. You mentioned Terra Luna. So I think we should keep in mind there are two different kind of broad categories of stablecoins. There are the asset-backed stablecoins like USDC and UST, and then there are, or USDT, and then there are algorithmic stablecoins like Terra Luna.
Right.
And so, and DAI, right, I think is another one. To me, the asset-backed stablecoins are the ones that look a lot like banks, and those are the ones that we should be concerned about in terms of something that looks like a classical run on the bank. The reason I would say it's actually less of a risk than this report suggests is because stablecoins, particularly USDC, are actually held to a higher standard than commercial banks are currently. So they have to have much more in terms of safe capital backing the stablecoins they issue than a bank does. A bank can, bank reserve requirements are on the order of single-digit percentages. I mean, they can reinvest.
Money multiplier is 12x still.
Yeah, because there's FDIC, there's all these. Yeah, so I mean, it doesn't make sense to me to think that stable coins are more at risk of bank runs than banks.
Yeah. The only difference I think with stable coins is it's 24/7. the bank runs can happen anytime, anywhere, and there's not as much you can do to stop it. What I think is the critical here, and is not talked about in the article, is the largest stablecoins in the space, USDC and USDT, of course, are both essentially one-to-one fiat backed now.
Exactly.
And before, when they had illiquid collateral, that's how a bank run would be problematic. But if you have $1 of fiat for every $1 of stablecoin issued, when somebody redeems, you're not worried about not being able to get the fiat back at the same one-to-one value. The challenge with Terra Luna and different things is they were using AVAX and they were using other volatile assets, which is still less risky than some of the commercial paper and stuff Tether was doing before. But it got out of hand. There was speculation that they didn't have reserves, which they didn't. And for that reason, everything just went.
I mean, originally Terra Luna, I don't even think had any assets backing it. It was purely algorithmic correct me if I'm wrong. It was purely algorithmic at first, and then they were just getting pressure from people saying this is way too risky, and they started building up an asset base to back it, kind of like as a backup. And then those assets were risky, like you said. Anyway, but originally they didn't have. So I think that's kind of a very different category of stablecoins, and those are quite risky. I mean, I think the interesting question is what's the right compromise? I mean, should we regulate stablecoins like USDC more like banks and let them take on more leverage and give them access to something like FDIC? Then running the stablecoin operation could be much more efficient. I mean, why wouldn't they have access to those same resources that banks do if they're serving a very similar function? And I think they are serving a very similar function, because when people hold USDC, it's like it's like a checking account, basically. Yeah. They can use it as a store of value, or they can transact with it. It functions very much like a checking account does from the standpoint of a consumer. So the question is, is the idea that we should move banks toward being one-to-one backed, like stablecoins, or should we move stablecoins? Should we let stablecoins take on more leverage so that they can have more capital efficiency, like banks?
So I have a question.
Probably somewhere in the middle.
I have a question for you on that front, and I'll frame it a little bit here, but. It's worth noting that you're an academic economist, so this is actually your wheelhouse. So anybody that's watching this isn't just two random guys. Patrick is actually a PhD on this topic, which is why we're talking about it. Just a shameless plug. That being said, I think one of the challenges that we talk about a lot on the show, and you and I talk a lot in practice and with our counterparties and vendors, is that the yield, the base yield, the real yield on chain right now is somewhat problematic. We don't have enough base real yield to actually earn enough revenue for protocols to be sustainable and to make positive net profit. So that's a bit of a challenge right now. Especially when you factor in the risk premium for smart contracts and novel technologies, et cetera. That being said, one of the reasons I think the traditional banking system is so successful is because they're able to do the 12x, used to be 20x, reserve multiplier. So they only need to hold 1/12. If you put $100,000 in there, 1/12 of it actually has to remain in there as a reserve, which, as you could imagine, is problematic if more than 1/12 of the consumer base tries to withdraw their money. All of this being said, it's one of the things that led to an explosion of banking success in the Western world is capital efficiency, being able to build in so much more real yield, both for the users and for the business. How do you think this plays out? Like, we have to get to a point, in my opinion, where we can replicate similar leverage opportunities as traditional financial markets, only because it's impossible to compete otherwise. So anyways, I'd love to hear kind of your thoughts from an economic perspective. Where do you think this kind of settles out? Do you think that we in fact should see a reduction in the money multiplier for major banks? Do you think that stablecoins will eventually catch up? Where are you at on that?
I think there's a lot of room for stablecoins to become more efficient in terms of their ability to use capital. And one way to do that is to allow some stablecoin issuers to be regulated the same way commercial banks are. And I think a lot of existing stablecoin issuers would kind of probably push back against that. But if you just look at the capital efficiency, access to things like FDIC, it seems inevitable given how similar kind of the user workflows are for USDC versus consumer banks, that there is a business opportunity here for a stablecoin issuer to come in, essentially be registered as a bank. I mean, obviously there are regulatory challenges here. There's going to be some back and forth. You know, you and I know how hard
getting a banking license. Getting a banking license, I heard, is super easy. So no big deal.
My guess is we will see over the next, call it 2, 3, 5 years, we will see stablecoin issuers, asset-backed stablecoin issuers, move into the space who are basically commercial banks, who are regulated like banks. Hopefully, it's crypto native builders who decide to go either partner with an existing bank or go through the work of registering themselves. That's probably better than having, you know, a JP Morgan issue their own stablecoin as kind of a replacement for some of their commercial banking consumer banking workflows. But my guess is we'll see more of that. I mean, I also don't think, to your question, and this kind of ties into the point we were making earlier, it's probably not the case that there's some overall kind of homogenous, there's kind of an optimal mix between banks and stablecoins that gives us a perfect amount of leverage that all of them should have. I think they will have different operational efficiencies. They will have different user bases. Users will have different preferences. And so you want to allow some banks and some stablecoins to take on more risk and some to be safer. And, you know, one really interesting approach on the banking side in crypto is Caitlin Long, the, what's the name of her bank? Custodia Bank. And she's kind of taking this to the other limit. You know, my understanding is that is a bank that operates with full one-to-one backing of the collateral. They don't reinvest the deposits the way typical commercial banks do. So I think there's scope for a lot of different, there's scope for variety here, and it's going to be a function
to see how they can stay competitive, though. Like that's the challenge. How do you make enough money to provide enough return to your users and to make enough profit? That's the real case study that'll be interesting.
I mean, it has to be product market fit, right? She's making the calculation. I mean, I don't want to speak for her, but my sense is she's making the calculation that there are enough users with the preference for bank accounts that are one-to-one backed that they're willing to accept lower yield to have that safety.
I mean, I guess it's probably worth noting most bank accounts don't pay the yield that they should anyways,
right.
As evidenced by everything that happened in the last 3 years. I mean, interest rates went bananas. Obviously, inflation went bananas. And the yield that you're receiving on your bank deposits have stayed exactly the same in most cases. So the bank is making sizably more money. Granted, it costs them more money, the overnight rate. I get it. But the end user is getting none of that, which to me is ridiculous and I think a shame. Woo! Thank you. That came out of nowhere. Okay. I mean, I think that I'm concerned, and I'm interested in your opinion on this one. I'm concerned slightly about an incumbency advantage again, that because we're dragging our feet so much on legislation and regulation, and maybe this is the point. Maybe this is what they're trying to do. I don't know. I don't want to have a tin hat on, but we're getting to the point where if we would have had some regulatory clarity and some approvals, some of these new fresh businesses with great leadership, Circle USDC is a great one, would have a much greater chance of maintaining, market presence. But if we drag it on and drag it on and drag it on so that they have more and more and more baggage for the SEC to jump on, and then incumbents come in with their banking licenses and banking track records, and they all get stablecoin licenses, that essentially wipes out non-incumbents. Do you think that's a reality? Like, should we be concerned about all of a sudden all this work that we've done open sourced in blockchain is going to be scooped up by incumbents that are just going to eat our lunch?
Yeah, I think it's a very significant risk. It's probably one of the biggest risks from the standpoint of builders in this space who want to build things that scale.
Right.
I mean, the incumbents just clearly have an advantage. And so that's why I think, my guess is we will see some implementations of stablecoins that look more like banks over the next few years. And the real question is it going to be coming primarily from kind of crypto native builders who either partner with an existing bank or get their own licenses? Or is it just going to be, Bank of America and JP Morgan Chase just kind of convert some of their checking account workflows to be implemented on like a stablecoin backend?
I think it's kind of like expecting a large government to move quickly. I suspect what you'll see is more of kind of the collaborative relationships between like a Coinbase and a BlackRock in terms of, BlackRock can borrow custody and some of the crypto expertise from Coinbase, also without having to put all of their reputation on the line on day one. And Coinbase benefits probably from some reciprocal vendor relationship with BlackRock and a whole bunch of additional liquidity and all of this other stuff that ends up being in many ways collaborative. I hope we see more of that. My concern is there's only a couple of Coinbases globally. And it's easy to see why a BlackRock would want to partner with a Coinbase, obviously, or a Binance or those big companies. But what about the small, medium-sized businesses that are emerging with incredible teams, incredible technologies, and just really trying to shape the future of finance? It'd be interesting to see what happens. I don't know. Okay, we've talked a lot about US-backed stablecoins. There's a few Euro-backed stablecoins. EuroC is the one from Circle, but there's a new one now that came out from. It's a new venture named All Unity, one of the original BitMEX founders, which I was actually talking about yesterday, in terms of leverage and risk and perps and how things just got out of control early on with lack of regulation. But all of that to say, they've partnered with Deutsche Bank, Flow Traders, Galaxy Digital. Like, these are big names to launch a Euro-backed stablecoin to compete with EuroC. And I think, again, my opinion on this is I love it. I love to see more options in the market, especially in different currency denominations. And here's why. One of the things that blockchain stands to be very, very, very efficient at is large international multi-currency transactions. There are ways to do it very cost effectively, very quickly, trustlessly via smart contracts. There's some incredible stuff happening, but we need greater and deeper liquidity and greater trust and greater regulation. So I'd love to see stuff like this where, again, this is another example of what we were just talking about. You've got Galaxy Digital and some of the guys from BitMEX. Those are crypto natives-ish, or at least they crypto OGs, not necessarily natives. A lot of them started in TradFi, partnering with Deutsche Bank, Flow Traders, et cetera, which are kind of fairly notable TradFi participants. So this to me is really cool. Like, I think we're going to see more of this. I like the collaborative nature. It's not Deutsche Bank coming out alone with this. It's, let's borrow some of the expertise of different partners. I love it. What are your thoughts on this? Do you think is there an efficient frontier for this where at some point we just in fact have too many stablecoins and we should focus on the 4 or 5? Or do you think that proliferation is advantageous?
It's a really good question. I mean, to your first point, I think it is a good sign to see this type of collaboration. And, we were kind of talking about this on the previous topic, to what extent do we expect or want to see incumbents involved with this type of innovation? And I like the way this was structured. Like you said, it's Deutsche Bank, but it's also Galaxy. It's also BitMEX, right? So, you have people coming from both sides. So I think we'll probably see more of that. In terms of the question about proliferation of stablecoins, it's very interesting. I mean, I don't know how many different stablecoins we need for each currency. In principle, you would probably want to have some for all of the major currencies. The question, do you want to see many different stablecoins for a particular currency? I think there are scenarios where you would want to see that, particularly if they're operating more like banks. For example, you see a lot of competition among banks they compete for users, right? And so we don't have a single bank in the U.S. There's not a single bank in England or France, right? There are many, many different banks, but all of the units of the deposit, the currency is all the same for all of those depositors. So I think even some proliferation within each currency category is probably good for the same reason that we want, banks to compete for consumers.
Yeah, I'm strongly in the same camp as you. I think we probably don't need to be at either extreme where there's like 100 issuers or 1 or 2 issuers. It's probably closer to the 1 or 2 issuers, but towards the 100 issuers, if that makes sense. Mainly just because, from my perspective, there's still a certain amount of unconscious incompetence in terms of design and risk management. So there's just certain areas that we as a space haven't encountered yet and just don't have all the information. And I think as novel technologies evolve, you need fresh approaches to similar problems so that you can figure out what is actually better in the end. And it gives consumers options. That's kind of to your point. The thought that there's ever only going to be one successful place in blockchain is, in my opinion, the biggest lie you could tell yourself. That's never going to happen. And the obvious parallel that I always draw is when Bank of America opened, whenever that happened, did every other bank just say, well, these guys are here now, so let's all close shop and let them take the pie? No, they all have different expertise in theory, and they all have different specialties and areas of focus and fee structures and product shelves and all of these different things that I think creates optionality in the market, both from a trust perspective. You have different teams and groups and entities that you can choose to trust, but also different products and offerings. And I think it keeps things meaningfully competitive in a positive sense. All right. Maybe as we round out the show today, I'll set the stage a little bit for your Substack that you wrote on this. It's phenomenal. Anybody that's watching, if you're interested in stablecoins and banking systems and how this actually kind of connects and eventually will be a future that incorporates both of them, Patrick has written a really good Substack on it. But to that end, Patrick, how does this in many ways evolve with the banking system? Like, what do we have other limitations that we haven't considered here in the space? There's many, FDIC, et cetera, but kind of what are your thoughts on that? How do you view this as an economist in terms of the future evolution of finance?
Yeah, it's a great question. I think there are obvious efficiencies that existing banks can enjoy by adopting some of this technology. The challenges are going to be, I think largely regulatory and also associated with any kind of, call it legacy frictions, incumbents not wanting to switch over their tech because it may benefit their competitors in various ways. So I think the main reason that banks would be sluggish, the main 2 reasons that banks would be sluggish to adopt this technology would be slow movement on the regulatory side, and then also just kind of legacy concerns. They're not wanting to give up any advantages they have as incumbents. For me, so there is a real question about how this innovation gets incorporated into the modern banking system, and it could be pushed by the incumbents, or my guess is it's probably going to have to be pushed more by people who are building new tech in this space, and then end up just being successful enough to be able to
that people want
the existing incumbents and have them incorporated in various ways. So that's my guess. It's hard to, there are just so many obvious efficiencies, though. The operating costs for operating a stablecoin versus the entire commercial
banking infrastructure.
It's unbelievable. And to your point on the previous thing too, it's not on the previous topic. It's not just the fact that stablecoins are demandable, the fact that you can kind of transact on demand, the fact that it's also a store of value. It also makes all of these cross-border payments unbelievably cheaper, faster, and simpler. So it's from my standpoint, it's kind of unavoidable that more of this infrastructure gets adopted into the mainstream banking sector. And I think there are a few reasons why incumbents will be a little sluggish. And so my guess is it will take some kind of ambitious crypto native builders to put something together that's successful enough that the incumbents can no longer ignore it.
Yeah. And we're seeing that with BTC and ETH a little bit, that, you know, with the emergence of ETF applications and all of this hoopla that's coming about with respect to January 10th and yada, 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 blah, blah, blah. I think one of the other things that's worth noting here, though, is that most of the incumbents are in a bit of a no-win situation, in that if they do nothing, if they say, you know what, this is going to, so here, and here's why, first of all, it cannibalizes their revenue. So traditional finance, one of my biggest complaints with traditional finance is they've built a moat so wide and so deep that it's damn near impossible for anybody else to get in. And so where they've increased revenue over the years is by creating more and more rent-seeking levels that, you know, there's regulatory capture, there's all of this other crap that happens. And these guys are saying, hey, like, this sounds cool, but we have like 10 tiers of revenue that we're essentially going to cannibalize if we do this. So that's the one side of the equation. The other side of the equation is we can keep our revenue until other people cannibalize it, and then we know we don't have our revenue anymore, nor do we have a presence in the future where, you know, there's some hybrid of blockchain involved. Do you think that's a big motivating factor? Are they really concerned, incumbents, about their revenues, or is it just natural business evolution from your perspective?
I think they are concerned about their revenues, and I think it's natural business evolution. I mean, I think yeah, they can both be true. But I think you're right. There is this system. The incumbents have become extremely entrenched because of layers and layers of regulation that have been kind of piled on top of each other over the last century, call it. Right. And a lot of that stuff is very hard to kind of unwind. And I think they lose revenue, but I also just think there are huge costs in terms of upending your existing operational infrastructure that they would be concerned about. So it's you know, they would have to, their expertise currently, many incumbents, their expertise involves managing this entrenchment layer that you mentioned. And if, to the extent they embrace new technology, then their expertise has to change away from managing that entrenchment layer into managing something they're less familiar with. But that's probably why we'll see more and more of these partnerships, you know, the Deutsche Bank, BitMEX, Galaxy, because then they can delegate some of that expertise to people who are already building in the space. The real
holy grail here is, and to your point, I have an example of this, but is if we can reduce expenses for incumbents by a big enough proportion that it more than offsets the loss in revenue. And I think if you factor in, like, and we're talking decades down the road, like the chances of a national stablecoin institution replicating the product offering of a major national bank in the next couple of years is zero, in my opinion. But in a decade or two, I think we may in fact see, a pretty good cost savings in brick and mortar. And that could, in fact, like, even without the money multiplier, even without, the reserve factor of 12, that could make this transition a no-brainer. It could be, like, if you think of all the retail space that they have, all the leases, all the people they pay, all the vendors, like, that's insane. That's why they have all this rent-seeking behavior, because they have to pay for all that exorbitant overhead, in my opinion. So it'll be interesting to see if we can find that.
I think, to your point, I think Circle could do it right away if they wanted to. I think they could do it very quickly. So if you're saying zero probability that we see any of these stablecoin issuers, take steps to operate more like banks, you're probably right. The reason I wouldn't put it at zero is just because, from a standpoint of capabilities, Circle could do it pretty much right away if they wanted to.
I should rephrase. I guess what I meant is to have meaningful replacement product offerings. So, like, Circle can offer stable coins with a banking license and FDIC insurance maybe, but until Circle, with no brick and mortar, is able to issue 401ks and IRAs and all of the other nonsense that you can do through your brick and mortar bank, which is, again, some of those extra layers of profitability on the banking system because you have captive clients already, captive users. I mean, it's going to take a minute. I think it's going to take a minute.
That's right.
That product offering out, but I mean, I wouldn't. Yeah, to your point, I wouldn't be surprised if we start seeing more and more. I mean, we're seeing Ripple acquiring custodians and tangential banking partners globally in lots of jurisdictions to try to, build their repertoire of licenses and compliance adherence. We're going to see some big moves. I think it's pretty exciting. PayPal with their stablecoin, like PayPal, in my opinion, is kind of the giant that's sleeping right now. No one's really been talking much about the PayPal stablecoin of late. Partially because PayPal hasn't really publicized it because they're fighting with the SEC slightly over how it's going. All of that to say, if we really want to see an incumbent that kind of straddles the space, or at least has, to PayPal's credit, they've been a notable supporter of blockchain for at least the last 5+ years. So it's really interesting. They have the financial wherewithal to play in the traditional system, but they also have a very dangerous level of knowledge and understanding and involvement in crypto, which I think, if I had to bet, I think PayPal's stablecoin will come bursting on the scene as soon as the SEC backs off. But I guess we'll see. Hey, one final thought on the stablecoins, because we should wrap up here for the day. But we talked a little bit about this on a previous episode, not you and I, but myself with someone else. And Latin America, very similar to Africa. One of the major advantages is remittance, right? People move out of their home countries and they want to send money back for their families and friends and whoever. And without blockchain and crypto, the options were MoneyGram, et cetera, right? And they charge 15, 20, 30 points in fees just to send money, which is insane. And there's a whole bunch of delays, and you got to go, and it's a nightmare. If you've ever sent money that way, it's a nightmare. So in Latin America, there as well as Africa, that's where we're starting to see incredible adoption of stablecoins for that reason. Their national currencies are inflating like crazy. Just holding their national currency, in fact, decreases their purchasing power because inflation is so rampant. So a lot of these people just want to hold something that's not being exposed to inflation the same way. As a consequence of this, we've seen about 80% of all transactions in Brazil, we reported on this last week, are USDT. 80% of all transactions on chain in Brazil is USDT. And that is echoed, that's the third largest or second largest globally, I think. But that's echoed by most of the other LATAM countries. There's a very high proportion of participation in blockchain involves merely stablecoins for just P2P transactions, transfers of value to different people, store of value in some ways better than their current currency. And we see that all over Africa also. Is this, again, is this just exemplifying kind of some of the benefits, or are we going to see a bit of a wave once it picks up in some of these more emerging countries? We have no choice but to accept it for POS and different things here.
Yeah, I'm not sure to what extent adoption in Latin America would drive adoption in, say, the US and EU. It might. I do think it's very interesting just because it illustrates this point we were discussing earlier about low-cost cross-border payments. I mean, I think that's why this has become so popular. There's also another kind of, and you touched on this. There's another subtlety here, which is it. Not only are the cross-border payments easier and lower cost, it's also easier for people to hold other currencies. So in particular, the US, but I mean, someone in Brazil could also get a euro stablecoin, just as easily, effectively. And so,
which is very difficult to do otherwise.
Is the ability of people to hold other currencies, which typically is quite hard.
Yeah, it's very difficult to do. Yeah, physically going to the bank, waiting forever. You get it in like cash as opposed to numbers on an account, so you can't send it internationally. Like there's a whole bunch of limitations to Forex.
Or going through your broker, and you have to set up a broker. You have to have a certain amount of money, and then you have to go into the FX markets to get exposure to other currencies.
Well, then you got to make sure that
most people who are sending these remittances are not also doing that. And so this is a very easy way for them to hold other currencies.
Yeah, I think it's great in so many ways. And again, it highlights some of the areas of significant inefficiency in the way we're doing things right now. Like, it should not be that difficult to get foreign currencies. I mean, everybody thinks it's easy because we have all these B-book brokers that don't actually settle your transactions with any of the actual currencies. They're essentially betting against you and offering you crazy leverage. And what a coincidence, most people lose money. If you can find an A-book broker, one that actually holds the underlying asset, that's usually pretty good, but fees are high.
Yep.
So anyways, all right. Patrick, it's been a pleasure. For everybody that's watching, if you liked this kind of a little bit more narrow and deep dive into a particular topic, we're going to do more of this after the winter break. I'm not going to share too many details right now, but we've got some pretty exciting stuff in the works. Patrick happens to be involved, so keep an eye out for some announcements in January, because we'll be talking all about it. With that, reminder to everybody, we're a live show Friday, 12:30 p.m. Eastern. Help us get the word out, because we don't commercialize this thing. Like, share, subscribe, hit the bell, do all that shit on Twitter or on YouTube. You know, subscribe to the channel. That really helps us out for reach and visibility. And with that, Patrick, I say to you, my friend, go find yourself. Later.